many of whom didn't expect such a rapid rise so quickly.
With inflation tumbling to its lowest level in 3.5 years. But interest rate cut could still be a way off.
The big economic question for 2024 is whether the Reserve Bank will start cutting interest rates this year.
Australia has experienced a significant shift in interest rates since 2022, as the Reserve Bank of Australia aggressively raised the cash rate to combat persistent inflation. These rapid increases have affected various aspects of the economy, from consumer behaviour and mortgage repayments to housing markets and employment. Understanding the factors behind these rate hikes, their effects and future prospects is essential for grasping their broader economic implications. Number 1, causes of the interest rate rise. The RBA's primary motivation for raising interest rates has been to address inflation, which remains stubbornly above the central bank's target range of 2 to 3%. Inflation, particularly in the services sector, has been driven by supply chain disruptions, rising labour costs, and strong demand post-pandemic. Also, wage growth has placed additional pressure on inflation as employers raise wages to attract talent in a tight labour market. The RBA has emphasised the need to slow consumer spending to bring inflation under control, leading to a series of rate hikes starting in 2022. In 2024, the RBA kept the cash rate at a high of 4.35%, marking the highest level in over a decade. This higher for longer policy reflects the bank's concern that easing too soon could reignite inflationary pressures. External factors such as the strong economic performance in the US and global market volatility have also influenced the RBA's cautious stance. Number 2, impact on consumers and households. Higher interest rates have significantly affected Australian households. Borrowers have seen their monthly repayments increase sharply, putting financial pressure on homeowners. According to recent data, household spending has slowed as more income is allocated to debt servicing. This has impacted retail sales and other sectors reliant on consumer demand, contributing to a general economic slowdown. The housing market has been particularly affected. Higher borrowing costs have reduced housing affordability, leading to a cooling of property prices in some areas. For example, annual growth in housing prices declined from 9.7% to 6.7% over the 12 months leading up to September 2024, according to CoreLogic. However, some regional markets like Perth have shown resilience, with house values continuing to rise despite the broader slowdown. Rental markets have also felt the strain. As fewer people are able to secure home loans, demand for rental properties has surged, pushing rental prices higher. This has exacerbated rental stress, particularly among lower income households, despite government efforts to increase rental assistance and affordable housing initiatives. Number 3, effects on the labour market and economic growth. The rate hikes have also impacted the labour market. As consumer demand weakens, businesses have been more cautious in hiring, with the unemployment rate expected to rise to 4.3% by the end of 2024. While job market conditions remain relatively strong, the RBA anticipates that wage growth will slow as economic activity cools. On the macroeconomic front, Australia's GDP growth has been modest, with just a 0.2% increase in the June quarter of 2024. The slowdown in economic growth reflects weaker consumer spending, despite strong public spending and population growth supporting certain sectors. Economic forecasts suggest that growth will gradually recover in 2025 as inflation eases and household income stabilizes. 4, future outlook and policy considerations. Looking ahead, the RBA has indicated that interest rates are likely to remain elevated for the foreseeable future to ensure inflation returns to target. While some analysts predict rate cuts could begin in 2025 if economic conditions weaken further, the central bank remains cautious, warning that any premature easing could reverse progress in controlling inflation. Much depends on how global economic conditions evolve, particularly in the US and China, and whether domestic consumption rebounds later in 2024. Policymakers are also grappling with the challenge of balancing inflation control with the need to support economic growth. Government initiatives such as increased funding for public infrastructure projects and rental assistance, along with the Stage 3 tax cuts, aim to mitigate the impact of high rates. However, further intervention may be needed if inflation remains persistent or economic growth stalls. The rise in interest rates in Australia reflects the RBA's commitment to stabilising inflation, but it has come with significant economic trade-offs. Households are bearing the brunt of higher mortgage repayments, while businesses are grappling with slowing consumer demand. The outlook for the economy remains uncertain, with the RBA signalling a cautious approach to any future rate adjustments. In the meantime, Australians will need to navigate an economic landscape shaped by higher borrowing costs and subdued growth. These developments underscore the complexity of managing monetary policy in a dynamic global environment, where inflation control must be balanced against the risks of economic stagnation. The next few years will be critical in determining whether Australia can achieve sustainable growth while keeping inflation under control. And that's all for today's video. Thanks for watching, and I'll see you on the next one. Peace.